The commercial real estate market is getting hammered. We just got data showing that foreclosure rates are skyrocketing as interest rates stay high and landlords can't afford to pay their mortgages. Now, if you're a visual learner like me, take a look at this. Commercial foreclosures sank during the pandemic, but over the last 12 months, we've been seeing this steady rise in commercial real estate foreclosures. But don't forget, if foreclosure doesn't just mean that a landlord is running out of money. It also means that a bank isn't getting paid. Banks are having to write off these bad loans, putting more stress on the banking sector at a time where the banking sector was already struggling. So let me break this down by talking about three things. What's going on in the banking sector, especially for banks that are lending money to the commercial real estate landlords. Number two, what's going on in the commercial real estate market? And number three, what does this mean in terms of opportunities? So let's kick this off by going over the banking sector. Now, we've already covered this in market briefs, but banks lent out a lot of money at 3%, 3.5%, 4% back in 2020 and 2021. Now, the value of those loans have fallen since then because a bank that holds a loan, if I lend you money for $10 million at 3%, but now interest rates today are 7%, the value of that loan that I originally lent you is less because no one's gonna buy this loan, this $10 million loan from me because you're only paying 3% versus the market is 7 or 8%. So the value of these loans have fallen on paper. On the bank's balance sheets, the value of these loans have fallen. Now, that's not an issue until it becomes an issue. Think of it this way. You buy a home that's worth $500,000, but then you find out that the home is worth $300,000. It's not an issue unless it becomes an issue. Meaning, if you can't make your payments, that's when it becomes an issue, because if you were forced to sell this home, well, now you're underwater. Assuming you have a mortgage worth $400,000, $350,000. If you have a mortgage worth more than what the loan is, now you're underwater and you'd have to bring more money to the table, or you get foreclosed on. That's kind of the situation that a lot of banks are facing, where they're underwater on these loans because interest rates are so much higher, so the value of the loans have fallen. But it's not an issue unless the banks are forced to liquidate these loans. Now, why would a bank be forced to liquidate a loan? Well, that happens if people start pulling the money out of the bank, or if the bank starts to run into financial issues and they have to sell off some of their assets to cover some other losses. Well, the situation becomes a little bit more complicated for the banks that have been lending money to commercial real estate landlords, because now we have some commercial properties, some office buildings that have lost a lot of value. We've seen office real estate fall. So now, if a bank owns a loan, which is now underwater, but not just that, the value of the property is underwater, well, that causes issues. Think of it like this. You bought a home for $500,000. You have a $450,000 mortgage on it, but now the home's only worth $300,000 and you can't make the payments anymore. Now you have to get out of this home. That's when you start to realize the value of the underwater asset. Well, with these banks that have lent money to commercial real estate landlords that are now sitting underwater on loans that are also on underwater properties, that's where it's starting to pose a problem. And this is something that we haven't really seen play out yet, but it's something you want to keep your eye on, because even the Federal Reserve Bank Chairman, Jerome Powell, has come out and said that he expects to see more bank failures because of what's going on in the banking sector due to the commercial real estate market falling. Now, again, if you want to stay up to date on what is happening in the financial news when it happens like this is why I created Market Briefs. Market Briefs is a free newsletter that my team at Briefs Media publishes every single day, Monday through Friday and Sunday. It's a free newsletter. You can read it in less than 5 minutes every morning, and I promise you are going to love it. And if you don't love it, well, you can unsubscribe at any time because it's free. So if you want to join Market Briefs, I got the link for you down in the description below, where you can go to briefs.co/market. That's briefs.co/market. This brings us to the underlying problem, which is what is going on in the real estate market, more particularly the commercial real estate market. And the first real trigger here is that we have this $1.5 or so trillion wave of debt in the commercial real estate market that's starting to come due a little bit in 2024, but even more in 2025. And the reason why this is important is because commercial real estate loans are not like your residential loans. When you go and buy a home, you can get a 30-year fixed rate mortgage. If you go and you buy an office building, you get a 3-year loan or a 5-year loan, maybe a 7-year loan. So these are shorter term readjusting mortgages, shorter term readjusting loans. And now, after everybody did a cash out refinance or took out a loan in 2020 and 2021, some of these loans are starting to come due in 2024, and more loans are going to start to come due in 2025. Now, why is this significant? Well, because interest rates are so much higher today than they were before. And the reason why that's significant is because office properties and commercial real estate properties are valued based off of how much money a property is going to make. Here's an example. Let's assume that this building right here makes $500,000 a year of profit, and that's after paying all expenses except your mortgage. So if any of you are real estate investors out there, this is your net operating income. And let's assume that this property is selling for a 5 cap, which is just a fancy real estate way of saying that it's a 5% return on your money, assuming that you bought this property cash. So again, we're assuming right now no debt, because that's the way the real estate investors value properties based off of this term called cap rates. I'm not going to get into that in this video, but just understand that's how it works. So you take this $500,000, you divide it by 5%, and that tells us that this building is worth $10 million. So now you want to go out and buy this $10 million building. Well, you're going to need some cash. Let's assume you put a 30% down payment and you're going to finance the other 70%. So you're going to get a loan for $7 million to buy this $10 million building. Again, this building's worth $10 million because it's generating $500,000 a year profit before debt. So now, if you take out a $7 million mortgage and your interest rates are 3.5%, which I know that's not what they are today, but we're going to assume that mortgage rates are 3.5%, that means a year you're going to be paying around $350,000 in debt costs, which leaves you with $150,000 in cash after paying your mortgage. Now, I'm not going to get into whether this is a good deal or not, but this is what an investor would say. Now, you would decide if it's a good deal or not deal if you want to go forward with it. The problem is, if we fast forward to today, we take the same property. It's making $500,000 a year. Now, if we do the same 5% analysis, you'd say, okay, this building should sell for $10 million, a 5% cap. But now you're going to have to go out and get a 7% mortgage. So now, if you get a 7% mortgage on the same property, that means every year you're going to have to pay about $552,000 a year just in your mortgage costs. The problem with that is you're only making $500,000 a year. So if you pay $552,000 a year in debt, that means you are at a loss of $52,000 a year, which means if you want to buy this property, either you got to find a way to get a lower mortgage rate, which is kind of difficult in an environment where interest rates are so much higher, or you're going to have to get a lower price on this property. You're going to have to offer a higher percentage return. Instead of a 5 cap, maybe a 7 cap, an 8 cap, which means the value of this property has to go down in order for it to be a worthwhile deal for an investor. This is why valuations for these types of properties have been falling, because investors just can't make any money with these high of interest rates. So if the value of these properties are falling, it's more difficult for the landlord of these properties to get a new mortgage. Because as these mortgages come due, they're going to have to refinance, get a new mortgage. That way they can continue to own this property, because if the lender is not willing to lend you the money, well, now you're in trouble. But that's just the first part of the problem. The second part of the problem is that properties are making less money, especially if they're in the office market, because a lot of office buildings are sitting 25% vacant, 40% vacant, in some instances 50% vacant. And so if a building is sitting vacant, that means you're not making money. It means you're making less money than before because you're not getting paid. But your expenses haven't gone away. In fact, expenses have gone up in many instances. Property taxes have gone up, insurance costs have gone up, maintenance costs have gone up, management costs have gone up. So now your costs of operating the building have risen, but you're making less money. So now you can start to see why office valuations have been falling. But now on top of that, you have to put everything together. So you have valuations that are falling, you're making less money, and costs are about to rise because your debt costs are about to rise. This is why a lot of landlords now, instead of foreclosing, have just been turning in their keys back to the bank saying, we don't want to deal with this property anymore. We're never going to be able to make any money on it anymore. So it's your problem. And it's the same reason why commercial property foreclosures have been rising over the last 12 months. And this brings us to part number 3, which is where's the opportunity. Now, anytime you see pain happen in a sector, it creates opportunity. When the 2020 stock market crash happened, it created opportunity for investors to go in and buy stocks at a discounted price. When the 2008 Great Recession happened, the financial crisis happened, it created an opportunity for investors to buy stocks or buy real estate at a discounted price. What we're starting to see happen is that some commercial real estate prices have fallen, especially in the office market. Not so much the apartment market, but a lot more in the office market. This creates opportunity for savvy investors to potentially purchase this property either for themselves or to renovate and potentially turn it to residential and turn it to something else, or to find some other opportunity with this property. But if you're saying, well, Jaspreet, I don't have millions of dollars to go out and buy an office property, well, what else could it be? Well, it can also create opportunity if you have a business to go out and lease an office and be a lot more aggressive with your lease. For example, you might have noticed that our studio setup looks a little bit different right now, and that's because it is. We're actually in transition of offices right now, and we just leased a larger, nicer office in downtown Detroit, and because of the shifting in the office market, we've been able to be a little bit more aggressive with our negotiations. Now, Detroit has been a little bit different, that the office market has actually been a little bit more resilient in downtown Detroit than a lot of other parts of the country, but it still gave us that opportunity to be a little bit more aggressive with our negotiations. So the question is, how can you find opportunity in these types of downturns? Now, I understand in the commercial office real estate market, it's a little bit more niche because not everybody needs an office and it takes more money to go out and start investing in office spaces. But what you want to be thinking about is how can you find opportunity when you see these types of downturns? Because we've seen it happen time and time and time again, that when you see pain happen in any asset class, it creates opportunity for the investors that can look past the emotion and find the opportunity. And that's what you want to be able to do, is look past the emotion and see, can you find opportunities somewhere? Maybe that means looking to invest in companies that are investing in office real estate. Maybe that means investing in stocks that are looking for opportunities here. Maybe that means you going out and doing it yourself. But you have to understand, when you see economic pain, it creates opportunity for the financially savvy if and only if you're willing to look past the emotion. This is a chart from the Federal Reserve Bank showing the rates of home ownership in the United States. And while home ownership today isn't at the 2004 peak, we're also nowhere near the lows. So we're kind of in like the historical average. Now, of course, real estate is a very local game. What's happening in one neighborhood might not be happening in a different neighborhood in the country.